Let's take a look at the Chapter 5 quiz questions that we started last time. Okay, and we didn't start them, but we looked at Chapter 5, and then we were going to go through the quiz questions, right? Okay, so let's just take a look at a couple of these, and you can go ahead and help me out with these as we go along. Get rid of that. Here we go. Okay, good. So let's just go ahead and look at this first one now. And it says Chapter 5 in it just because that's my way of tracking what chapter I got the material from. At one point in time I put all the questions into one big file, and now I separate them by chapter. So that's the only reason that's there. Okay, but we acquire equipment. Okay, did you pick up your Scantron? Okay. We acquire equipment in the general government services that have been acquired several years ago by special revenue fund at a cost of $45,000. Now, when we acquired that equipment, we would have done what in the special revenue fund? Who wants to give me the journal entry to acquire equipment in a special revenue fund? In a special revenue fund? We're using modified accrual accounting in the special revenue fund, so we're going to go ahead and debit expenditure, right? How much did they say they paid for it? $40,000. Okay. And credit, and we'll just assume they paid cash. Eventually they're going to have to pay for that, so we'll just credit cash, whatever, okay? Okay, good. What would I do at the government-wide level for the same transaction now, government-wide? Now I'm going to debit equipment, right, using full accrual accounting for $40,000 and credit the cash, whatever, right, for $40,000. With me so far? Okay. Okay, good. Now we go ahead and we use this equipment for a while, and over a period of time at the government-wide level, we'd be debiting depreciation expense and crediting accumulated depreciation, right? So when we sell that equipment, what should we do at the government-wide level? Even though this question was asking what should happen. Oh, well, they are asking me what should happen at the government-wide level. So when I sell the equipment, what should I do at the government-wide level? Complete journal entry, please. When you sell equipment, full accrual accounting, you know, business 120 stuff.
Debit cash.
I'm going to debit cash for $15,000.
Decrease your accumulated depreciation.
You want me to debit it or credit it?
Debit it.
Okay. Debit accumulated depreciation for $30,000. Good. Credit equipment, good, for $40,000. And there's going to be a loss of $5,000 using full accrual accounting. Okay. So when they ask me at the governmental activities level, should there be a debit to cash? Come on, guys, it's right here in front of you. I'm expecting like a religious experience here. Yes. What's the next scripture? Should there be a debit to accumulated depreciation? Yes. Got a debit to accumulated depreciation. Good. Should there be a credit to the equipment for the original cost? Yes. Should there be a credit to other financing sources? Not at the government-wide level, right? How about the same transaction if since we bought the stuff in the special revenue fund, I guess we'll account for the sale of it in the special revenue fund. What do you want me to do in the special revenue fund when I sell this? Debit cash, good, cash debit. For what, 5,000? Right? I mean, 15,000. Okay. What do you want me to credit here? Other financing sources, you want me to credit for how much?
5,000.
Why 5,000? Okay, go ahead. Get on that island. Now that you're on that island of 5,000 all by yourself, how are you going to get off it? I need some more credits. Here, I'll help you. Here comes the boat of one. 15,000, okay. We're going to credit the other financing sources for 15,000. I mean, you're kind of transfixed by this, and I guess that's nonsense no matter what, right? Okay. Now remember, I said last time this could also be other revenue. Okay. There's not a real clear designation from GASB whether they want it to be other revenue or other financing sources. So both would be acceptable, but it doesn't matter because we're not going to have this at the government-wide level, right? Nor the fund level. There's a credit to other financing sources, but not for 15,000, not for 5,000. Okay, good. How about this one, number 2? Who wants to help me with this one? So we got a capital lease. Present value of the future lease payments is $745,500. That's the future lease payments. What does the future mean? What do we mean by the future? What do we mean by the future? Huh?
Something's going to happen?
Well, it's not happening right now if it's in the future, right? So there's now and there's the future, right? Okay? Right? So this means it's going to happen not now and in the future, right? Okay? Okay, good. So we're going to have future payments of $745,000, and then they tell me there's a down payment of $25,000. When do down payments happen? Down payments happen now, right? When you go after you get out of San Jose State and you get a nice accounting job, you're going to go buy a Porsche, and the guy's going to say, well, there's a $25,000 down payment, drive off $25,000. So you're going to say, you want that now? And he's going to say, yeah. And you're going to take out your wallet, that wad of money that you hold together with a rubber band, and you're going to peel off $25,000 to the dude, right? Okay? All right, so that happens now, doesn't it? So we got $745,000 of payments that'll happen in the future. $745,500 payments that'll happen in the future, and we got $25,000 that's going to happen what? Now, right? We're clear on that? Okay. So what's the journal entry for this whole thing? Debit cash for $25,000. I'm acquiring this asset under a capital lease. When you acquire something under a lease, you have to pay cash. You don't receive cash. Right? Okay, so what do you want to do with cash? You're going to credit cash for $25,000, okay? What else?
Do you recognize an expenditure for something?
Oh yeah, you're right. We're in the general fund, aren't we? Okay. So what do you want to do in the general fund? Debit expenditure for $770,500, you say? Well, how much am I paying for this piece of equipment, whatever it is? $745 plus the 25 down, right? Some of it's going to be in the future. Some of it I'm going to pay out now, right? Okay, good. So we paid $770,500 for this thing, right? And so what do you want to do, sir, with a bomb on your computer? What's your name? Angela. What do you want to do with the rest of this, Angela? Huh? Well, look, play jazz with it. Pretend I said, hey, I'll give you $770,500 if you get the rest of this right. Okay? So what do you want to do with the rest of this? I'll give you half the money if you get half of it right. What are you saying? Modified accrual accounting general fund. But you're on the right track. Just remember what fund you're in. Huh? Good. We're going to credit what? Other financing sources. Right? And this is going to be capital lease, but it's a long-term financing, isn't it? That says capital lease. And since it's long-term financing, we'll credit that for what? 700 and what is it? 45,000? 500? Thank you. 745,000. These commas. $745,500, you say? Like that? Okay, does the journal entry balance? Okay, I'll give you the 770,000 later. You guys can split it. You get nothing. Okay, no, okay. All right, so what's happening? We've got this what? We've got this 745,000 other financing sources, right? Isn't that how we count for the at the fund level? Right? Now, what's happening? You look and you're like, well, then what's the answer, John? You're saying D here, and you didn't even put a number there. I must have had some problem with this one. The answer here is 0, because what this was thinking, the fire truck should be recorded, and they mean the fire truck asset. Would have made that question more understandable. The fire truck asset should be recorded at what? 0. There is no fire truck asset. It's expenditure, isn't it? They said the fire truck. They meant the fire truck asset. They could have been a little more clear about that. Okay? Okay, good. They could have been a lot clearer about that. I could have been a lot clearer about that because I could have fixed that question before I put it on Canvas, right? Okay? But this made it more interesting to you. Okay. All right. Now, the fire truck asset should be recorded at the governmental activities. Same set of facts now, but now we're asking you the full accrual journal entry under full accrual accounting, right? So what's the journal entry now? You want to debit equipment under full accrual accounting? For what? 770,500, you say? Which was the answer to this question? Okay, good. How about the rest of the journal entry?
Credit cash for 770,500.
Why? Cash is not going out. You're right that cash has to be credited, but let's not go crazy here now. Cash gets credited for what? 25,000. I'm still making the down payment, right? What do you want to do with the rest, Carolyn? I didn't know there's that many people. Your name's Carolyn? I know. Thanks for your enthusiasm, guys. I'm saying that because I kind of said, whoa. Now I want to give her a chance to come back. Well, I need 745,000, don't I? 500 to make the journal entry balance?
Would it be a gain?
No.
Credit?
No, it's obligation or capital lease. It's a liability, isn't it? Is that what you guys are saying? Well, you can call it that if you want, but you won't impress your friends at parties if you call it that. If you call it an obstinate obligation under capital lease, everybody will go, ooh. If you just say lease payable, nobody will be impressed. But if you say obligation under capital lease, then everybody goes, ooh. Yes, you can call it lease payable. It's a liability, bottom line here, right? Okay? Full accrual versus modified accrual treatment, right? Okay, good. What's your name? Huh? You have your test? How do you have your test? How'd you get your test?
Last time is
Was she here last time?
no, I don't.
So how'd you get your test? What's your name, sir?
I asked my friend to for me.
What friend? Don't take anyone's test. That causes me problems. Then all of a sudden, I don't know where the Scantron is, and the person says, well, I know I got 100. And what am I supposed to say? No, you didn't, because there's a Scantron out there somewhere that says something else on it. Don't take the other person's Scantron. What was your name, sir? Ning. Okay. Is Wendy here? How about GA? Can you hand that? Wendy, no? Okay. Okay. Question on that? Okay. What number? Here, 4. Okay. The following are the city of Beaver Creek's capital assets. And we have, we want to know what gets included in the governmental activities column. Okay. So when we're at the government-wide level, we have 2 columns. We have what? Governmental activities, and we have business activities, right? Okay. Okay, good. What's going to go under my governmental activities? First one who answers gets an ice cream cone. General fund, special revenue fund, good. Debt service fund, capital project fund, and permanent fund, right? Plus what? Plus the internal service fund, the S and C Poppy, right? Okay, good. Okay, what about under the business type activities? Enterprise fund, good. What about my Pappy funds? Not reported, right? Okay, good. Okay, so they're asking me governmental activities, and I guess I have to look at these things and see where they're reported, right? So how about capital assets used in proprietary fund activities? Oh, that's not a very good question. Yeah, what a horrible question. Okay. How about capital assets used for public purpose trust funds? Trust funds, guys, by definition, are our fiduciary funds. So I'm not going to pick those up. And so now I have what? I have general government assets, 7 million. Oh, I see. Oh, no, it's a horrible question. Yeah, it truly is a horrible question because what? By saying proprietary funds, they meant, and when I read this, I read enterprise funds, which is what they meant. But if they say proprietary fund, that could also be an internal service fund, couldn't it? So I really would expect you to come up here and say, John, did you mean? And then I would say, oh, the answer to number, since it's an enterprise fund, I mean $1 million over here, I would say that the answer to number 5 here is what? No, A. I mean, if they're saying the answer is A, and I'm saying, okay, if that's the case, they wanted to put the $1 million as an enterprise fund, didn't they? Right? Horrible question. Okay. Okay, number 5. You see why that's a horrible question? They should have called out to us that they meant an enterprise fund, right? Okay. Okay, good. Let's go ahead and let's take a look at in which of the following funds or activities general journals would it not be appropriate to report depreciation? What? Capital project fund uses modified accrual accounting. We don't have depreciation there. Internal service fund, full accrual. Business type activities, full accrual. Governmental activities, full accrual, right? Okay. Okay, good. A city accounts for a capital acquisition using encumbrances when the city enters into a contract to acquire equipment. I mean, I'm calling this Chapter 5. This really was what? Chapter 4, Chapter 3? But I put it in there anyway because I want us to remember that we're still using encumbrance accounting when we're in the capital project fund, right? Okay. Okay, good. Following set of facts now for the next 3 questions. State constructs an office building. The construction, and we have different sources coming in here. We have transfer from the general fund. We have a grant of $2 million from the federal government, and bond proceeds of $7 million, and earnings from temporary investments. And the question is, which of these is revenue? And I think the grant is pretty easy, isn't it? Okay. Now you look at that $2 million and you say, well, I can't get to any of the answers unless I also pick up what? The investment earnings. Okay, now I have another objection with this problem, in that I'm not sure that investment earnings are revenue. Those are more what? Investment earnings, right? Gains from investments and stuff. I wouldn't necessarily call those revenues, but you can't get to any of the other answers unless you throw that in with the revenues, right? Okay, but the grant from the federal government is clearly a revenue. Now, how about the bond proceeds? What is that? Good, that's going to be another financing source, right? Long-term debt financing. How about this money that came in from the, we got $2 million from the federal government is a revenue. Where's this other one that came in? Transfer from the general fund of $1 million. What do you want to do? How do you want to treat that one? Transfer in from the general fund. That's also another financing source. Good. So if I were to put the question on the test where I'd go ahead and I'd ask you the other financing sources, the answer would be the $7 million plus what? Plus $1 million would be $8 million for that. I like questions like that. I can go ahead and what? Ask you the same question almost, and then I just have to change the choices and make a different right answer out of it. Okay? Okay, good. So, oh, here we go. Hello. I should probably look at the next question. Other financing sources is how much? 8 million. Okay, good. How about for our buddy the general fund? What should it do in this transaction? And it's going to do what? It's going to debit other financing uses. What? Transfer out? For $1 million. And we're going to credit what? Cash for that $1 million. Okay. Okay, good. And that's another financing use. Okay. So, you know, if you looked at the first exam and said, oh, okay, he gave us the answers. That was so easy. Geez, we didn't even have to learn anything, blah, blah. You know, the chickens will come home to roost. If you don't actually learn that stuff, you're going to pay the price. I can still ask it, can't I? Because it's still relevant to the transactions and the other funds. Okay? So make sure, even though you maybe got a good grade on that first test, make sure you're still keeping track of the basics here as we go along.
Uh-huh. So it's the other financing uses. It means it's you're transferring out $1 million in cash.
Mm-hmm.
Okay.
Yes, out of the general fund into the capital project fund. I think this money was going to, right? Into the capital project fund. So Carolyn, in the capital project fund, we will simultaneously debit cash for $1 million and credit other financing sources, and this is going to be a transfer in, isn't it? For $1 million? Right? So what happens when I go to prepare my government-wide financial statements? What should I do? I'm going to start at the fund level, and I want to set a government-wide statements. Do I want to show amounts that were transferred internally? So we kind of have like a revenue and expense that's being reported between two subsidiaries. So how do you want to handle that? The consolidating journal entry to turn the fund financial statements into government-wide. Carolyn? No, you're fixing your hair, right? See, I don't have that problem. I never get called on by accident. Well, we would debit what? Other financing sources. Go ahead. Transfer in for what?
$1 million.
For $1 million, and credit what?
Credit cash?
No, the cash, leave it alone. Cash, we debited it, we credited it, it had no ultimate effect on cash, right? Cash stayed the same government-wide level, right? But I'm going to credit the what? Credit the transfer out for $1 million, the other financing use, that is gone, right? And the cash really was a wash when I debited and I credited, so the cash is fine, isn't it, at the government-wide level? Huh? It's eliminating journal entry. It's like eliminating the interest revenue and the interest expenditure when you've had interest between two companies, right? Unless you're Enron, then you try to leave them both on there, or at least the revenue part. Okay? Okay, good. Okay, let's come over and let's take a look at number 10. Okay, and a city acquires equipment of $1 million by means of a capital lease. The agreement calls for paying the leasing company $300,000 in three $100,000 annual payments starting December 31st, 2013. The present value of the three lease payments using a 6% interest rate is $267,300. The city will make the lease payments from the general fund. What journal entry should the city make in the fund? And it is what? Debit expenditure, credit other financing sources for the present value of the minimum lease payments, right? Okay, good. Oh, no. Where's the next question? So, what happens when I make that first lease payment? It says what? Three $100,000 annual payments? Who wants to give me the journal entry for that first payment? We have to pay these on December 31st each year. So how about for the first year? 2013 in this example. Huh? You want a credit cash? You want a credit cash for how much? 100,000? Is that the amount of the payments? Okay, good. In the fund financial statements now, what is it? General fund that's paying for this? Credit cash for 100,000. What do you want me to do?
Expenditures for $300,000, right?
No, I want this. Let me give you a hint. The only credit in this journal entry is going to be the credit to cash. Huh? What payable? Where? Where are we? Are we in the general fund?
So you'd have to do other financing uses for that 100,000, right? Debit it.
Not under the current rules of the Government Accounting Standards Board, no. Huh? What? I'm going to debit expenditure for the $100,000 because I spent $100,000, didn't I? Right? This is what I was telling you guys. This is the thing that I was saying is going to be weird. You're going to sit there and you're going to say, huh? You debit expenditure when you acquire this asset for the present value of minimum lease payments? Yes. Fund balance goes down by that amount, but it also goes up by the other financing source, doesn't it? And then when I make the payment, I debit expenditure, I credit cash. Now fund balance came down because I've used a current financial resource, haven't I? I just did. here, fund balance does what? Fund balance goes up 267,300 by the other financing source. It goes down 267, what is it? 300 by the amount of the expenditure, right? Right? Okay, remember, we're under modified accrual accounting here. When I acquire a physical, a capital asset like a piece of equipment, what do I debit when I acquire equipment? What do I debit when I acquire equipment? Expenditure. So I debit expenditure for the present value of the lease payments, which was this. I'm just writing it in general journal form here. 267,300, right? And I credit what? I credit, There's no cash. I'm signing a lease. When you go in and you sign a lease, you tell the guy, you see that blue Porsche over there? That's the one that I want, and I don't want to leave you any money. Is there any way I can do that, Porsche dealer? Yeah. He'll say, sure. Can we get your social security number? And they run a credit check on it. They say that you made a lot of money in his account. Sure, no problem. You don't have to leave us any money. Would you like to lease that? Yes, I would. So you drive away and you don't leave the guy any money. Right? Okay. So we're not leaving any money behind. We can't credit cash. We can't credit lease payable because we don't have any long-term debt liabilities in this, say, the general fund or capital project fund, whatever fund this happens to be in. So we have to credit what? Other financing sources for long-term financing, capital lease, whatever. Okay, but it's still another financing source for $267,300, right? Where do we report expenditures in government? What financial statement? Where do you report expenditures? On the income statement, you call the statement of revenues, expenditures, and change in fund balance, but it's equivalent to the income statement, right? Okay. Where do you report other financing sources? No, we had the discussion of the statement of revenues, expenditures, and change in fund balance. We had revenues minus expenditures. That was going to be excess of revenues over expenditures. That was like the operating income number. And then we kept going, and we had sort of the non-operating section where we reported other financing sources and uses on that statement of revenues, expenditures, and change in fund balance on the income statement, right? It was like a non-operating item. So this is my explanation. Again, so revenue does what? Fund balance goes up by the amount of other financing source. Expenditure, fund balance comes down by the amount of expenditure. It's a wash on fund balance, isn't it? That's why it's okay to go ahead and debit expenditure again and credit cash as you pay for this thing. Now fund balance is coming down because I've used a current financial resource, cash, haven't I? Right? Just showing you this is how we account for this. You debit the expenditure, you credit the other financing source at the time that you acquire the lease because you've acquired equipment, you've used long-term financing for that, so we debit expenditure, we credit the other financing source, and then when we pay cash, we debit cash, don't we? We've been doing that. When we use cash, we credit cash, we debit expenditure. We've been doing that for a long time now, haven't we? Okay? Sure. Now, how about same journal entry, government-wide level? Not same journal entry. It's going to be different journal entry. Same transaction, government-wide level. Government-wide level for the acquisition. Debit equipment. This is now government-wide, right? Debit equipment for how much? Right here, when I make this transaction, what do you want to debit equipment for?
$267,300.
$267,300. Good. What do you want to credit? Lease payable. For $267,300. Right? Okay. What about when we pay this thing? Going to pay this $100,000. Now we're making the first lease payment. December 31st. Got to make a $100,000 payment a year for the next 3 years. I'll accept the credit to cash for $100,000. When did I sign this lease? When did I sign this lease? January 1st. And I'm making the first lease payment December 31st. What do we do in the United States when you have a transaction like that? In the United States, when you have a transaction where you borrowed some money at the beginning of the year and you're not paying it back to the end of the year, what do we account for? Interest. So I have what? I have $267,300. What's the interest rate on this stupid thing? Times 6%. What does that give me? What are you waiting for, the calculator angels to come down and do the calculations for you? What do you get when you get that? 16,038. 16,038, you say? Okay, good. So what am I going to do with that number? Debit interest. Come on, guys. It's a straight accrual. Debit interest expense, 16,038, right? And the difference goes to what? The lease payable, right? So what's that? 83,962, you say?
962.
Like that? Okay. Expectation that you know this, expectation that you know this. I could ask you either. I could ask you, what do you do at the fund level? I could ask you both. What do you do at the government-wide level, right? Okay. Question? Yes, sir.
The expenditure and cash entry you made, so for the second year, it'd be the same entry, right?
Yes. Yes. Same entry for year 1, year 2, year 3. At the government-wide level now, in that second year, we would amortize the remaining balance, the $267,300 minus the $83,962, and that would be the new carrying value of that lease liability, and we'd multiply that times 6% to get the interest expense, I should say, for the second year, right? And so on. And I'm assuming they've bothered to make this thing amortize completely down after 3 years. If they haven't, then shame on them. I won't make you go into 3 years. I would just make you do the 1 year. Okay? Okay. Question on any of that? Okay, let's get into Chapter 6 then. Or you want to take the break right now? Too early for the break, right? Right now while you're on fire with knowledge. You don't want to take the break. Okay. Okay, so let's go ahead. Let's get ourselves into the Chapter 6 once this thing saves. Once this thing gets off a spin cycle here. I don't know why it's taking so long. I should be able to go ahead and go, though. Let it do what it wants to on that end. I don't care if it saves it or not. Okay? Okay, so let's just go ahead and let's take a look at Chapter 6 now. Okay, so we've spent some time now understanding the accounting for our capital assets at the government-wide level. Obviously in the earlier chapters we were dealing with our current assets, right, including inventory, which will be part of our next midterm, the purchase method, the consumption method, right? Okay, but we spent time in Chapter 5 then looking at accounting for our capital assets at the government-wide level, and we saw how the capital project fund would be used to keep track of resources that are accumulated then to construct a capital asset that will eventually be reported as a building or whatever the example was at the government-wide level, and we close out the capital project fund, right? Okay. Now, in that example, we borrowed money. Remember, we borrowed the bonds for $5 million, and remember, like 50,000 got sent over. The bond issued at a premium, and 50,000 got sent over to the debt service fund. Okay, so here comes a debt service fund now, and it's got 50,000, but now it's going to have to accumulate additional money to pay off both the principal and interest on that debt, right? And remember, we said last time that usually that money comes from where to pay off the principal and interest? I know they got a 50,000 head start, right? But there's still what, like 5 million left to go that they had to come up with. Where does most of that money, and they have to pay the interest, so where does most of that money typically come from?
General fund.
It's cash, but where does the cash come from? Huh? Oh, tax, you're saying? Tax that is being paid into the general fund, right? Okay, so when you go vote in a couple weeks, I don't know if there's any measures on Santa Clara County's ballot if you're voting in Santa Clara County, and they say, do you approve the issues of bonds for, schools or something? And you sit there and you look and you picture children, walking into the sunset somewhere going to school and no money coming out right now. Eventually money will come out of somewhere, won't it, to pay back the principal and interest? Okay, that's why it was nuts that for a good, I'd say, 10 years in the 90s, they used to keep it. This is what used to be the campaigns back in the 90s. You guys were too young to remember. This is what they'd say in political campaigns. Vote for John Lord. He's tough on crime. And then he'd stand up there and he'd say, I approve the measure to issue bonds to build more prisons. We're going to lock them up and we're going to put them away. Now, what kind of stupid investment is that? To do what? To incur debt. Incur debt to do what? To build a prison to put future people into it later. I mean, how stupid is that, right? But that's what they say. He's tough on crime. One time they had the election for the insurance commissioner, and they said, vote for whoever the insurance commissioner was at the time that was running. Vote for Hutchinson. He's tough on crime. And I'm thinking, don't we want him to be tough on insurance companies? I mean, he's the insurance commissioner. What do I care if he's tough on crime or not? I don't care if he shoots somebody walking in his house, as long as he sits there and, never mind. Stop. Okay. Cut. Okay. All right. So anyway, so be careful. But what happens? We're going to see in this example, that's exactly what's going to happen. We're going to sit there and we're going to issue debt, and we're going to pay back that debt out of money being transferred from our general, the general fund to the debt service fund, and then the debt service fund is going to use that money to pay what? To pay back the principal and interest. And when a governmental fund spends money, how do we treat that? The credit is the cash. What's the debit to? Huh? The debit is to expenditure, and it's not going to matter if it's principal or interest. It's still going to be a debit to what? Expenditure. Okay? That's the major takeaway here. Okay? So we start to look, and we talk about the activity of the fiduciary fund. And very important, guys, that we realize that if debt is issued by one of the proprietary funds or one of the fiduciary funds, that is not the responsibility of the debt service fund. They are using full accrual accounting. They'll account for all that just like you would in commercial accounting, as they take on the bond payable and pay the principal and interest on that, right? Okay, we're only talking about when debt has been issued by the governmental fund. Maybe the general fund issued some debt. Maybe the capital project fund issued some debt. Would the debt service fund ever issue debt? Why would the debt service fund issue debt? Why would the debt service fund issue debt? Does your personal debt service fund ever issue debt? Do you ever take on a debt to pay your debt? Have you ever done that? Have you ever taken on a debt to pay off your debt personally? Huh? When did you do that? Don't worry. I mean, I'm not looking for a moment of indiscretion. Well, I was really on hard times, man, and I had to get my. The guy said he would only break one of my legs. He actually broke them both. I'm not looking for a story like that.
Sometimes you have to balance, a cash advance place against a credit card payment or something like
Something like that. Okay, but I was thinking more. I'm sorry. The more refinancing of a house. When you refinance a house, what do? You sign a debt to pay off debt, don't you? Okay. So it could be that the debt service fund could actually also issue debt to pay off another maturing debt, right? In fact, if it's all the federal government does. Every time its debt comes due, it does what? It issues new debt to pay off the old debt, right? And a little bit more. Until it all of a sudden has what? $20 trillion of debt? Okay, good. So anyway, what's happening? So when that is happening from the other funds, we don't account for it in the capital project fund. In the debt service fund when the other funds, not a governmental fund, issues debt, it's not accounted for in the debt service fund. It's accounted for as a liability in the proprietary or the fiduciary fund. However, often that debt is backed by the full faith and credit of the state or local government, and so under those situations we would still put in a footnote disclosure that there is this contingent liability for this debt that could be could have to be backed by the full faith and credit of the government. Okay, good. So come over. And all kinds of different types of long-term debt sources, tax-supported bonds, long-term notes. We've already seen the capital lease obligations, haven't we? Sick and vacation leave. I'm not getting into that in this class, guys. I don't care. Okay, that's beyond the scope of what we need to worry about in this class. Pension obligations. I'm just going to mention that there's a pension fund when we get to it. Okay. Pollution remediation obligation, I'm not going to get into. It's simply a sinking fund where they put money in to clean up a garbage dump. When we get into the enterprise fund, I'll expect you to know that that's accounted for in an enterprise fund, but I'm not going to hold you accountable for the accounting on that. Okay? But different types of debt that government could get into. Okay? And we're going to go ahead and see here that we will account for the general debt of this governmental activities column on the government-wide statements, right? Okay. General term, long-term liabilities are not reported in the governmental funds. Okay. We will do what? We will repay the debt and interest out of the principal and interest out of the debt service fund. Okay, so when we issue the debt in the fund that's receiving the cash, say the capital project fund, what journal entry will we make when we issue that debt? Let's see if I can write on this guy. Yeah, okay. I don't like this guy anyway. I'm not going to even talk about his slide, so I'm just going to write on it. Huh? When I issue debt in the capital project fund, I issue debt, capital project fund accounting. I issue debt. I issue a bond for $1 million with a $10,000 premium. Go. Debit cash for what I say, $1 million? $1,010,000 I said? Is that what I said? Debit cash? Okay, what do you want me to credit? Capital project fund. Capital project fund. What do you credit when you issue long-term debt in a governmental fund like a capital project fund? Other financing sources gets credited for $1,010,000. Right? Okay. And what happens if I want to send this money over to the debt service fund? Huh? Why not? Beautiful. Transfer it out. Just transfer it out. Just debit what? Just debit Other financing uses, transfer out. There we go. Now we're beginning to get into this. Debit the money, what? Other financing uses, transfer out. What do you want me to credit? Cash, good. So that money's gone now, isn't it? That 10,000? See, I don't like this guy. I'm going to just write on his face. 10,000? Okay. What do you want me to, I'm sending it over to the debt service fund. What do you want me to do in the debt service fund? Debit cash. Now we're starting to rock. Credit. Sources. Good. Other financing sources. This is now transfer in. TI, transfer in for 10,000. TI, transfer in for 10,000. The money's now in the debt service fund, which is where I want it to be, right? Right? Okay. How about at the government-wide level? What do you want to do? Same transaction. Government-wide level. Debit cash for what? Okay. Fine, then I'll put it over here then. Debit cash for what? 1,010,000. Credit bond payable, good, for what? 1 million, good. What do you want me to credit? Huh? 1 million. Credit bond payable for 1 million. What do you want me to credit? This is not balancing.
Loss of $10,000 credit.
First of all, if it was a credit, it wouldn't be a loss. It is a credit, though. Also, I'll agree that it's a credit. What's the credit to? Premium on bond payable. Premium on bond payable. That's a premium, guys. Come on now. I'm starting to get chest pains. What? So we're sitting here. We're dealing with what? Bond payable is how much? Prepare my balance sheet. Bond payable is what?
$1 million.
1 million. The premium is how much? Premium is 10,000. So the what? The carrying value of that bond is $1,010,000, isn't it? Right? If that bond has a 10% interest rate, what's the interest for the first 6 months? Forget about governmental accounting, kind of. 10% interest rate on this bond. Interest rate for the first 6 months. Go ahead. 1,010,000 is the carrying value of the bond. 10% interest rate. What's the interest rate for the first 6 months? Set it up for me. What are you guys, partners over there? What are you, Penn and Teller? You know, you put the number down and you show it to him on the calculator and he speaks. What'd you put into the calculator? Oh, you got a sore throat? Oh, okay, I'm sorry. Sorry, I didn't realize you had a sore throat. Okay, so what is it? 1 million times, let's see if I can speak for you, okay? Did you say to him, multiply that times 10% times 1/2? Is that what you said to him for the 6 months? Times the 6/12 for the 6 months? That's what you said? Say, go like this, go. That's what I said. Okay, so how much is this interest for the first 6 months? 50,500, you say? Like that? Okay. So what's the journal entry now for that after the first 6 months? Say I'm paying say I'm paying, well, yeah, the bond, let's see, say the market rate on this was 10%, but the coupon rate was 8%. What is this? Like somehow I'm asking you something hard. This is like, peanut butter and jelly accounting for bonds here, guys. If the bond's carrying value is $1,050,000 and the coupon rate on the bond is what? 8%, and we're talking about a semi-annual interest payment. Was it a million? What did I say? Million what? 10,000 was the carrying amount of the bond. 1,010,000. So 1,010,000 times 8% times 1/2 is what?
That will be 40,000.
40,400. Okay. So that's $40,400 of actual interest expense, right? Because I have to use what? I have to use the carrying value times the times the coupon rate of interest, don't I? Wait a minute, I've messed this thing up now. I messed up my own example. Wait a minute, the coupon rate is 8% in my example? Make the coupon rate 12%, sorry. Coupon rate is 12% because the coupon rate has to be more than the market rate in order for the bond issued at a premium.
So that would be 60,000.
60,600, you say? Okay. So if this is the coupon rate and that is the market rate over there, who wants to give me the journal entry for this? Cash, I'm going to pay what? $60,600 of cash. Okay. I'm going to do what? I'm going to sit here and debit interest expense, and I'm going to use the market rate of interest for that, which interest expense is what? 50,500, you say? 50,500. Do I need a debit or a credit to make this journal entry balance? I need a debit of what? 10,100 is the debit I need. What am I going to debit? No. It'll have a net effect on bond payable, though. Well, this bond didn't issue at a discount. It issued at a premium, didn't it? So do you want to debit the premium then? So I debit the premium, right? Of 10,100? Okay, so if when I originally got the bond, I did what? I debited cash 10,000, just looking at what I wrote on the screen here. I credited bond payable of $1 million. I credited the premium for what? 10,000. Now I just debited the premium for how much? How was that possible? What did I do wrong? I did something wrong. We did something wrong. Probably because I messed up the interest. I know why. Because I didn't do present value tables here and come up with the actual present value for the bond, and I made the numbers up, etc. And so it should have been some different amounts here to make this work, and I just made up the interest rate on this because it wouldn't have issued at a $10,000 premium if we had a 10% interest rate on the thing and a coupon rate of 12%. So that's why it didn't work. But I certainly would debit the premium for what? For how much? 10,100. And I'm going to debit the interest expense. How much is the interest expense? 50,500. And I'm going to credit the cash for what? 60,500. 600. And again, I messed up my present value here. When I credit the premium and just pretend that I credited the premium for the full 10,000, I've debited the premium, just pretend I debited for the full 10,000, the premium would become 0, wouldn't it? And the carrying value of the bond would come down to what? To this 1 million, and there should have been a remaining carrying value that I would have gone ahead and multiplied that times the semi-annual interest rate, and I would have carried on, etc., right? Right? Okay. Now, if I'm accounting for the same transaction in the debt service fund, when I pay this cash of $60,600,000, what journal entry should I make? If I'm paying this money, what I just gave you was the government-wide accounting, right? But we're paying this interest out of the debt service fund. So what journal entry do you want to make to pay this cash out of the debt service fund? Huh? You want to credit cash? Okay. So if you credit cash for 10,000, what was it, 10,600? Even though it completely obliterated the entire premium, which is unrealistic. It wouldn't just do it in one payment. But we go ahead and we credited cash 10,600. What do you want to debit? Where are you transferring that money to? If you want to debit to OFU, transfer out, where are you transferring that money to? The bondholders will be real happy with that. You paid cash out of the debt service fund and you paid it over to the general fund. The bondholders are going to be just thrilled with you. Who are you paying this money to? Huh? Really? So you borrow money that the government doesn't have. You borrow $1,010,000 that apparently the government doesn't have to do what it wants to do. You borrow that money and then you pay that money back to the other funds. Well, who are you borrowing the money from? Okay, stop. The government needs money. Who does it borrow the money from? From the public or whoever, right? From investors. I don't know. From aliens. I don't care. But it's not from the government. They're borrowing the money from somebody else, right? Right? So we got this $10,000. Who are we going to pay it back to? To the people that we borrowed it from, to the bondholders, right? Okay? And so we went ahead and we did what? We showed the interest expense. We showed the amortization of the premium at the government-wide level, even though my amortization got a little bit screwy because I didn't think about present value accounting very well there. But I'm paying the cash out of the debt service fund. So when I pay cash out of the debt service fund, it's leaving the government and it's going out to whoever the bondholders are. What do you want me to debit when I credit cash for $10,600? I don't have a bond payable. I'm in the debt service fund. I'm using modified accrual accounting. I already dealt with the government-wide where I debited the bond payable. I debit expenditure because I'm spending cash, right? Okay. For $10,600? Okay, so what happens? We issue the debt. When the debt comes in to the capital project fund, we're debiting cash. We credit other financing sources. Fine, we transfer some cash over to the debt service fund, that premium amount, because the debt service fund's going to need it, aren't they? Because they're the ones that when the principal and interest come due, they're going to pay it out of that fund, right? Meanwhile, at the government-wide level, what are we doing? In our governmental activities column, we're setting up the bond payable. We're reporting out the bond payable. As we pay down the bond payable, just like you were supposed to learn already, you sit there and you do what? You amortize the premium on that, and you amortize the premium and you recognize your interest expense and pay down, amortize the premium, right? And then when the principal comes due, eventually this bond payable will be for the face of the bond, won't it? And at that point in time, you'll debit the bond payable, credit the cash at the government-wide level. In the debt service fund, when you pay back the principal, what journal entry will you make? Good. Debit expenditure for what? If I'm paying the principal, it's going to be for the full million, isn't it? And I'm going to do what? Credit the cash? Okay? Okay. So that's the whole thing that's going on here, but let's just go ahead and let's take a look at this example, okay? And in this example, they're talking about a bond that is issued for $100,000, and they're calling this a bond that is going to pay semi-annual interest January 1st and July 1st, and they borrow $100,000. Okay? Now, in this example, they're going to pay off this $100,000 in installments. Okay. We're going to pay this off in installments. So they call this what? They call this a serial bond. And it's not cereal, C-E, not the cereal you eat. Serial like a serial number. Okay, they call this a serial bond because what? The serial numbers for a strip of the principal come due every year. Okay, and so we're going to pay this off in chunks. Okay, now this question gets all into, if you look it up exactly the way the text presented it, they're going to pay this thing month after month after month. You're going to follow this all through. This is not necessary. I simply want you to understand that both the principal and interest when we pay off this serial bond is going to be what? Is going to be expenditure out of the debt service fund. We're going to account for the debt using full accrual accounting at the government-wide level, doing what? Paying down the principal, paying the interest, right? Okay, that's all that's going to happen here. Okay, well, one other thing's going to happen. The general fund is going to send the money over to the debt service fund to make these payments of both principal and interest. Okay? Okay, so that's all that's happening here. I'm not going to go that fast. Okay? So, when we issue the bonds in the what? In the governmental activities, we'll debit cash, we'll credit, and they're calling this serial bond payable. Okay? Interest rate on the bond is 6%, and it's a semi-annual bond. So what's going to happen? We issue them on December 1st, 2013, and there'll be $3,000 that'll be due on June 1st, 2014. For the first 6 months, that bond's outstanding. And then what? There'll be another $3,000 payment on December 1st, 2014. The what? The second 6 months, right? We will also pay down $5,000 on this bond over the next 20 years. $100,000 divided by 20 years is $5,000. So we're going to pay principal and interest on this bond, right? Okay. Everybody see where the $3,000 came from? 100,000 times what? Times 6% times 6/12, 1/2, whatever is where they got the 3,000, right? And they got the 5,000, that's the principal, just by taking the 100,000 dividing it by the 20 years. Okay? Now, they don't show me here, I don't think. Let me see. No, they do not. What entry is being made in, say, I don't know, say it's the general fund that borrowed this money, this bond. They're showing me governmental activities. They're showing me government-wide, right? What should I be doing in the governmental fund level? Okay. Don't get too excited about that transfer out thing now. Okay. I know that I was heaping praise on you for a minute ago, but don't go back to that well too often here. Okay. What's happening now? I'm issuing the bond out of the capital project fund or general fund, doesn't matter. A governmental fund, I'm issuing the bond out of there. Okay, good. Debit cash. This is in the capital project fund. I'll just make it capital project fund. Debit cash for how much? 100,000? The fund level? What do you want me to credit? Hang on a minute. Okay, go ahead. What do you want me to do in the capital project fund? Huh? Other financing sources, right? Hello? Come on, guys. I've said this like 90,000 times up here. When you issue debt out of a governmental fund, you sit there and you debit the cash, you credit other financing sources, right? For the bond proceeds. For what, 100,000? Right? Where do we report other financing sources? Statement of revenues, expenditures, and change in fund balance. That's right. Okay? All right, so we got to report that there on the income statement, right? Now, let's say we spend all this cash in year one. We would have debited expenditure, credited cash. So the 100,000 coming in and going out is all happening on the capital project fund. It comes in, it comes out, it's gone, right? But we still have to pay back the principal and interest on this, don't we? So what's going to happen? At the government-wide level, we'll account for this using full accrual accounting. At the individual fund level, we'll use modified accrual accounting. Every time we pay these, what? 3,000s and this 5,000 of principal, we're going to treat it as an expenditure, aren't we? That's all that's happening here, okay? So what happens? We go ahead and we set up the bond payable at the governmental fund level. We just treat it as an expenditure. It washes on the income statement, and then as we spend that money, it'll reduce the fund balance by the amount of cash we actually spend, right? Okay? Okay, good. So we go ahead and we do our budgetary accounting inside of our debt service fund. And since we've determined that the general fund is going to send the money over to the debt service fund, they're going to send the two interest payments, which are $6,000, and the $5,000 interest payment for year one, right? So in the course of the year, they're going to send me $11,000, aren't they? So we will debit estimated other financing sources, because the debt service fund is going to be, the general fund is going to be transferring the money into the debt service fund, and we credit what? We credit the appropriation because the legislature will allow us to spend that money on principal and interest, and we go ahead and we appropriate that accordingly. Okay? Okay, good. So we go ahead, we set up the appropriation. We don't do budgetary entries at the government-wide level. Okay, good. Then we come over and we go ahead and here comes the money. They send us that first interest payment, which is due June 1st. They're sending it to us, they don't wait till the last day. They send it to us a couple days in advance. So we debit cash, we credit the other financing sources, transfer in. That's coming from the general fund, isn't it? What journal entry should I be making in the general fund? General fund sent the money. They're showing me the debt service fund entry. What's the general fund going to do? Credit cash for 3,000, good, and debit what? Other financing uses. This is a transfer out now, isn't it? Coming out of the general fund. So there's that first interest payment, right? Do you notice anything interesting about the debt service fund right here? It spent money, didn't it? What do we usually do when we've been spending money in this class?
Record at the governmental level?
Yes, but that's not what I'm looking for here. I shouldn't have said, because we're transferring money, and you don't have, they're saying no entry at the government-wide level for the transfer because that's going to be eliminated, right? Remember I said before we would sit here and do what? We would sit here and debit the other financing other financing sources, transfer in and credit the other financing use to get rid of that. So they're saying no entry at the government-wide level. And when they say no entry at the government-wide level, that means an eliminating entry, actually, that will completely wipe out that transaction. Right? Because we don't have this dual track accounting that they're contemplating here. Okay? What was my question? I forgot what my question was now. Huh?
What are we not doing
Yeah, thank you. What are we not doing here with the debt service fund when we spent money that we've been doing out of other funds when we spend money? Can you spend money without encumbering it? No encumbrance entry here, right? They did not debit encumbrance. They did not credit budgetary control. Why not? This is a recurring expenditure. When you have a recurring expenditure like salaries and those things, you don't use the encumbrance, right? So for the debt service fund, no encumbrance. There is no encumbrance piece of this. This is the debt service fund. The legislature appropriates exactly what they need to meet the debt service. So there's no chance that, geez, mysterious debt got issued. Who issued that debt? I don't know, but now we got to pay. No, they know what the outstanding debt is. They know what the debt service is on that. They appropriate what they need to meet the debt service, don't they? Okay, so we didn't have to do the encumbrance entry. Yes, we set up the appropriation and the estimated transfers in, but we don't have to do anything with the encumbrance. Okay, so we go ahead, the money comes into the debt service fund, and when the money comes into the debt service fund, now they're going to use that money to do what? To pay the interest. They debit expenditure, bond interest. They credit the cash, right? The debt service fund's doing their job. Right? Isn't the point of these funds to show that money's being spent for the intended purpose? Isn't that what's happening? Yes, sir.
Sorry, back 1 second. What you just said about no encumbrance for the recurring items?
Yeah.
Is that only in the debt service fund, or is that
No. That's any recurring item. But the two main ones that we need to know in this class is debt service and salaries. No encumbrances for those. Okay? They consider those recurring. And those are the two classic examples of recurring. In other words, we're not going to burden the government with all this budgetary stuff. When we know we've got a certain payroll, we got to meet our payroll. We know we've got a certain debt service, we got to meet our debt service. So they don't burden them with all this encumbrance stuff. Okay? Okay, good. So we go ahead, we debit expenditure, we credit the cash, right? Notice at the governmental activities level, instead of using the word expenditure, we said expense, but it's pretty much the same entry, isn't it? Because we're paying what? We're paying the interest here, aren't we? Okay. Okay, good. So we go now to that payment that has to be made on December 1st. So what happens? We debit cash, we credit other financing sources, and now they're transferring in $8,000. That's the $3,000 second interest payment plus the $5,000 principal, right? So they go ahead and they debit cash, credit other financing sources, and then on December 1st, we pay that money out of the debt service fund. What do you do when you spend money out of a governmental fund? Debit expenditure, and notice, guys, it is both what? For the principal and the interest portion are both debit to expenditure because the debt service fund is doing its job. It's paying the principal and interest on this debt. When money is spent for its intended purpose, we treat it as an expenditure, don't we? Right? So how much have we spent out of this fund now? $11,000? This 8 plus the first interest payment of 3? Okay, all of it is expenditure. Now we come over, and at the government-wide level, yes, the $3,000 is interest expense, but what? The $5,000 is, the $5,000 is what? Bond payable because we're paying the principal on that now, aren't we? Right? Full accrual accounting. Okay. Now, very important. Only at the governmental activities level do we have to accrue the interest for the month of December. Notice at December in the debt service fund, since no interest is due on December 31st, there is no accrual of interest. No accrual of interest in the debt service fund. We do not accrue interest in between interest payment dates. Our next interest payment date is what? is we just made one on December 1st. The next interest payment date is June 1st of the next year. Right? So are we in between interest payment dates? Are we in between interest payment dates? We're in between interest payment dates. Notice what? For the governmental activities, government-wide level, full accrual accounting, you accrued that 1 month of interest, didn't you? At the individual fund level, debt service fund, you do not accrue interest in between interest payment dates. So I could very well give you a question on the next exam in which I'll say the city of Hayward issued bonds on January 1st and interest is due January 1st each year thereafter. The bonds were for $1 million. The interest rate is 3.7908 and the bonds were issued March 11th. How much interest should Hayward accrue at December 31st of year one? The answer that will be down in the D position will be 0. And if you're not careful, you're going to be sitting there. This person's going to be sitting there going through all kinds of funky calculations, right? Trying to get to March 11th. How many days is that? And what's this interest rate? Meanwhile, wasting a bunch of time, the correct answer is down there in D, which is what? 0. You do not accrue interest in between interest payment dates when we are talking about the debt service fund. At the government-wide level, full accrual accounting, it even has the word accrue, you have to accrue the interest, don't you? Okay, so that's what they're showing us there. Okay, now this problem kept going with the closing entries, and I guess that's okay. We debited the appropriation to close them. We credited what? Estimated financing sources to close them. We debited the other financing sources for the amounts that got transferred in, and we credited the expenditure, the $2,000-$3,000 interest payments plus the $5,000 principal to close that, right? Just reminding you of the closing entries. Okay? I don't care about the rest of this bond. I know that they had to go and they had to keep paying it. They had to do what? Then they had to pay year 2, and in year 2 now the bond has a carrying value of $95,000 times 6%, and so they're going to send the money over from the general fund to the debt service fund to pay now that reduced interest. They'll pay another $5,000 of capital, and I think the book kept going. I've seen enough. I only need to deal with 1 year to understand that both principal and interest amounts are what? Expenditures out of the debt service fund as they pay that back. Okay? Okay. So they keep going. I don't care. Okay? Now, the other thing that a government could do is it could use a sinking fund. A sinking fund is used in lieu of a serial bond. So if you have a term bond, what's a term bond? Term bond, what? Matures in a certain term, 5 years, whatever it is, right? So the term of that bond in that example was what? 20 years? Okay? If you have a term bond and pieces of it aren't going to mature every year, okay, over that, whatever it is, 20-year period, what you could do instead is save the money. So at the end of the 20 years or whatever, you have the $100,000. And all the sinking fund is a savings account then, isn't it? Okay, so all they do on this next one is say to you, well, okay, if you have to save $100,000, how much should you save each year so that Johnny can go to school or whatever it is? It's just like a savings account, isn't it? And you'd sit there and you go to the future value of an annuity to figure out how much to save each period to end up with $100,000 at the end of I guess it's 5 years instead of 20 years, whatever it is. I don't care about savings sinking fund calculations. I could care less. That's just a savings account. That's all that is. If you want to go to school and have $100,000 for Johnny at the end of 5 years, when he's 12 years old, how much should you save? Save, if you assume a growth rate of 7%, save $17,389 every year, and Johnny can go and get a nice education for $100,000, right? What happens if you don't save this $100,000? Guess he's going to junior college now, isn't he? Okay, all right, whatever. Okay. No, nothing wrong with junior college. Okay. So what happens? Special assessment. Let's just go ahead and knock this thing out. I think we're pretty close to the end anyway. Let's just knock it out now that we've gone this far. Special assessment. What happens here? So let's see. Let's see. You live in a certain part of town. It's a little dark over here, isn't it? We need some street lights. So we're going to put some street lights in over here. You okay with that? Okay, good. So he agrees to have some street lights put in. So I need the money for the street lights. So I go to some bondholders and I say, hey, want to buy a bond? You say, sure. So you give me some money to put in the street lights, right? So you give me this money. I need to go to a builder. So I go over here to the builder. I give the builder $50. The builder now comes over and builds the street lights, right? Nice and bright over here, isn't it? Isn't it beautiful? Okay. By the way, I need the money to pay back the bondholders for your street lights, right? So what happens? I go ahead and I assess the property holders for the principal and interest on that, and I pay back the bondholders. There you go. Look, you're already making a return on your investment, right? Okay. Still nice and bright over here? Some more principal and interest is due, and so I go ahead and I do what? I assess the property holders that benefited directly from that special assessment, and I pay back the bondholders. Okay? Now, when the government does that sort of activity, and the government is potentially or primarily liable, we account for that in the debt service fund. And of course, the streetlight construction is going to be accounted for where? Construction of streetlights. Capital Project Fund. Very good. That's going to happen in the Capital Project Fund, and the debt payment that we play acted here is going to come out of the Debt Service Fund, isn't it? And that's when the government is potentially primarily liable. Okay? So account for the Debt Service Fund for special assessment when the government is what? Obligated in some manner for that debt. Special assessments get accounted for in the what? Debt Service Fund, Capital Project Fund, when the government is somehow obligated. What's your name again, sir? Todd, you were minding your own business, weren't you? And I came over and said, hey, street lights, and we're going to assess you. And okay, and you kind of went. So what's going to happen if you don't pay? We're not going to say, okay, bondholders, go ahead. Go get them. Steal the street lights, take them to court, whatever. You're going to come after me and say, hang on a minute. You backed this with the full faith and credit of the government, or I wouldn't have bought that. You pay me, John, and I'll put a lien on your property, right? For any special assessments you don't pay. Okay? Now, sometimes, in some circumstances, the government does this sort of thing that we just play acted as an accommodation. They sit there and they say, okay, so you're building a housing development, are you? And you're going to connect up your pipes to the rest of the sewer pipes, right? I'll tell you what, we're going to go ahead and we're going to hold that money in escrow because we want to make sure that that thing is financed correctly. We don't want you halfway into our sewer pipes and then you can't finish the thing or something. You got sewer pipes half open while you're doing this thing. So we're going to hold that money and we're going to make sure that you have the funding available to now pay the sewer pipe construction people, etc., right? If you don't pay the sewer pipe construction people, ultimately, who are they going to come back after? No, they're going to come after you if there's some problem where there wasn't the appropriate funding. We don't get on the hook for that. We were doing this as an accommodation to make sure that the funds were flowing correctly, but we're not going to get in there and we're not going to say, oh, okay, gee, you're a little short on money. We got you. We'll bankroll this, right? That's not the case. If that's the case where the government is simply doing this as an accommodation and they're not what? Obligated in some manner. If somebody defaults, then it's between the two parties that are not related parties, but the two parties that are subject to this agreement, whatever. That is accounted for in the agency fund. So if the government is not obligated in some manner, we account for that in what? The agency fund. Agency fund is the A in Pappy. That is one of our fiduciary funds where the government is doing what? Holding money on somebody else's behalf, aren't they? Okay, so government is potentially liable, accounted for where for special assessment, gets accounted where? Debt service fund. If it's a special assessment and it's being where the government is not potentially liable, it gets accounted for where? Agency fund. Okay, that's all you need to know about special assessments. Okay? And the nature of what they are. And they're directly on the property holders. It'll benefit from that. Okay? You know this already, don't you? Hello? When we sign a capital lease, governmental activities level, we debit equipment, we credit what? Lease obligation payable, whatever. Okay? And what do you want to do at the individual fund level? Debit expenditure what? For how much? 50,000 and credit what? On what planet do you debit expenditure? Oh, I see. Yeah, in credit cash. That's all right, but no, not for this one. What do you want to credit when we sign the lease? This is when we sign the lease. What do you want to do?
Credit lease payable?
I'm at the fund level. What? I'm going to credit other financing source lease obligation, right? That is now the 11th time we've said that. For 50,000? Right? Okay, good. So that's all they're saying here is you go ahead when you sign the lease, and then when you make the payments on the lease, what are you going to do? You're going to debit expenditure for the lease payment of $10,000. I know that some of that is interest and some of that is principal, but at the lease level, we treat it all as expenditure. Remember before I was just debiting expenditure for the whole amount? It's all expenditure, isn't it? Isn't it all expenditure? Okay. Do they show me the the government-wide level here? No, they don't. What do you want me to do at the government-wide level? What do you want me to do at the government-wide level? You want me to debit interest expense? For how much? 5,759. Principal expense. I'm going to debit lease payable. $4,241. And credit cash for the 10,000. Right? So we've already done this now. This is the 12th time. Okay? Okay, good. So what we're going to do is get out of here now. I need you to do the following. I need you to get onto Canvas and look at the Chapter 6 homework questions. We'll work those at the beginning. Chapter 7, Chapter 8, and then we're ready for the next midterm, right? So if you've been taking a vacation from governmental accounting, it's over. Time to start getting in and looking at these things now. Chapter 5, Chapter 6. Next time, chapter... When is the next midterm? Huh? It's that soon? November 9th? What's today? So what do we got? The 26th? Hang on a minute, guys. So we got what? We've got... hang on a minute, guys. October 26th. We do we do chapter 6 homework, chapter 7 slides, right? Okay, forget it. We'll just figure it out as we go along. Chapter 6 homework, chapter 7 slides. Plus chapter 7 homework. We should be able to do that homework. And then we'll do on November what? 2nd? Chapter 8, we're going to see is largely definitional. So we'll go through quickly chapter 8, and then we'll do our review, midterm review. And then on November 9th, we'll do what? Chapter 6, 7, 8, okay? And chapter 6, and 5. Chapter 5 and 6 are going to be the heavy chapters. 7 and 8 are going to be definitional. Kind of, except I'm going to expect you to know about the statement of cash flows. I am going to expect you to know about the statement of cash flows for an enterprise fund. So we're going to have to spend a little bit of time on that. Chapter 8 will be largely definitional. Okay, sound like a plan? Potentially, with time permitting, we may actually get into chapter 8 next time as well. Because, again, that's going to be pretty quick. So we may be able to clear ourselves of chapter 7 and 8 next time. And then we'll be free and clear to do the practice for the midterm on the 9th.
Are you going to give us practice midterms?
Yeah, I'll give you practice midterm. And we'll do that on the 2nd, I mean. Quizzes. Quizzes for chapter 6 are up there. Okay, and I'll get the stuff for chapter 7 and chapter 8 up there as well so that we can get into that next time. The quiz for chapter 6 is already up there. And then we'll do a practice midterm for chapter 5, 6, 7, 8 like we did last time. We'll do that on the 2nd. I may even turn it into a mock midterm. Maybe I'll bring you guys some midterm questions, and you're going to have to sit here and respond to them without knowing the answers in advance. Okay? Question? All right, guys, I will see you on next time on Wednesday. Thank you. Thanks, appreciate it. If you didn't pick up your midterm, if you're the one, pick it up. Huh? So, I don't know, man. They
have bye this weekend?
They have no. They play. They going to Florida. They got to play Jacksonville. The problem is they don't have any defense. I mean, they're giving up 500 yards a game. It's ridiculous.
With the people they have, I would think they're like top 3 at least with defense. Like you have